Welcome back to the deep dive. We're jumping right in today with something, well, frankly, quite puzzling that's been happening in the markets. The Korean won, the KRW, has been surprisingly weak against the US dollar. And this is happening even when the Korean stock market, the KOSPI, is doing well, which is not how things usually work.
No, it's really not. Historically, you'd absolutely expect a strong KOSPI to mean a stronger one. They tended to, move together. But lately, that relationship seems broken. We've seen the one hit, 4,460 per dollar recently. And even with the KOSPI surging, it's only pulled back very slowly, maybe to around 4,450.
Yeah, and we did see a couple of things recently that maybe took the immediate pressure off a bit, like less worry about short-term U.S. financial markets and maybe some hope the U.S. government shutdown wouldn't happen.
Right, temporary relief. But the source material we've looked at is pretty clear on this. Those were just two factors. There's a list of 10 things driving this underlying weakness.
So the immediate sort of crisis moment might have eased, but there are 8 fundamental structural reasons still pushing the one down.
Exactly. And that's our mission for this deep dive, to really unpack those 8 core issues that analysts are pointing to. These are the things keeping the one weak despite other positive signs.
Okay, but before we get into the weeds on those 8 points, we really need to stress something important for you, the listener, especially when thinking about your own decisions. This analysis is about finance, about the flow of money. It's crucial to keep that separate from politics. Currency valuation follows the money, period.
Absolutely. And look, the consistent investment advice based purely on these economic flows since 2019 has been pretty straightforward. Keep about 50% of assets in US dollars and maybe 10% in gold. We're tracking the economics here, not taking sides.
Okay, crystal clear. Let's dive into those 8 reasons then. Where do we start? The sources seem to point first at monetary policy. Maybe some failures there.
That's right. Theme 1 is monetary policy, specifically the Bank of Korea's stance. And cause number 1 is probably the most significant driver, this massive historic interest rate gap between the U.S. and Korea.
Right. Interest rates are basically the price of holding a currency. And the BOK, the Bank of Korea, is keeping its rate really low compared to the U.S. Fed.
Exactly. You've got U.S. rates sitting in the 3.75% to 4.0% range. Meanwhile, Korea's benchmark rate, just 2.5%.
That's a huge difference if you're managing large sums of money.
It's a no-brainer, financially speaking. Look at the 2-year government bonds. Something big investors watch closely. U.S. bonds yield around 3.6%. Korean bonds only 2.7%. Why would you convert your dollars earning 3.6% into one to earn just 2.7%? The incentive just isn't there.
And the sources say this isn't just a minor blip. This rate reversal, where Korean rates are lower than U.S. rates, is the biggest it's ever been historically, a 2.0 percentage point gap at its peak.
Yes, the largest gap ever recorded. But honestly, host speaker, the size of the gap is only part of the story. What's really unprecedented and maybe more damaging is the duration.
How long it's lasted.
Precisely. This situation, this rate reversal, has now been going on for 41 consecutive months.
Wow, 41 months. How does that compare to previous times this happened?
It dwarfs them. Previous reversals, like back in 99, 2005, 2018, they lasted maybe 21 months, 25 months, 23 months, nothing close to 41.
And what does such a long period, 41 months, do psychologically to companies, exporters?
It fundamentally shifts expectations. It starts to feel like the new normal, not just a temporary phase. Companies stop thinking, oh, we'll just wait a bit for rates to normalize before bringing our dollars home. They basically accept this low-rate environment in Korea as potentially permanent, which means they have very little reason to convert their USD earnings back into KRW. Those dollars stay offshore.
Okay, so that's a huge structural pressure. Low rates, discouraging money from coming in. And that ties into the second point under monetary policy, doesn't it? Excessive money printing.
It does. You can't have policies pushing capital out while simultaneously flooding the domestic market with more won and expect the currency to stay strong. Let's look at M2 growth. That's a broad measure of money supply. Since January 2022, U.S. M2 grew by about 3%.
Okay, 3%. Seems modest.
Now compare that to Korea. In the same period, Korea's M2 supply increased by a massive 20.4%.
Wait, say that again? 20.4% compared to 3%?
20.4%. It's a staggering difference.
How was the won not at like 2,000 per dollar then, with that much more won flooding the system?
Ah, that's the key. It would likely be much weaker, perhaps hitting 1,600 much earlier, according to our sources, if not for one thing. Massive intervention by the Bank of Korea. They've been burning through foreign currency reserves at an incredible rate just to buy one and prop up the exchange rate.
So they're essentially fighting their own monetary policy, printing money with one hand and then spending reserves to soak it up with the other.
In effect, yes. It's like trying to hold a beach ball underwater. You can do it for a while, but it costs enormous energy, and the moment you let up, the ball shoots back to the surface. That underlying pressure from the M2 growth is still there. Interventions just cause these temporary dips before the rate snaps back up.
Okay, so monetary policy is creating this huge imbalance. That leads us to theme 2, structural supply and demand imbalances for the dollar itself. Cause number 3 is about the supply of dollars drying up.
Exactly. Korea relies heavily on exports. So traditionally, exporters are the main source of dollar supply in the market because they bring their foreign earnings back and convert them to one for domestic expenses, investments, etc.
But now, they're not doing that.
Well, why would they? As we just covered, the interest rate gap gives them zero financial incentive. Keep your money in USD, earn 3.6%, convert to KRW, earn 2.7%. It's simple math.
Plus, I think the sources mentioned other pressures, like needing to invest in the U.S.
Yes, there are strategic factors too. Global supply chain shifts, political pressures maybe, requirements to invest locally in major markets like the U.S. It all adds up. Both financially and strategically, it makes more sense for many Korean exporters right now to just keep their dollars as dollars outside Korea.
And this dollar shortage from exporters has been going on for that same record period, the 41 months.
That's right. It's a long-term structural drying up of the main dollar supply channel.
Okay, so supply is down. What about the demand side? Cause number 4 points to massive structural dollar demand. From who?
The National Pension Service, the
Yeah.
NPS, they are a huge player, and they are consistently, relentlessly buying U.S. dollars and dollar-denominated assets. This represents over half of their incoming insurance premium.
That's constantly buying dollars month after month.
Constantly. And this creates this huge ongoing demand pressure pulling the won down.
Sometimes you hear criticism like, is this unpatriotic for the National Pension Fund to be sending money abroad?
Yeah, that criticism comes up, but the sources are really clear. It's absolutely not unpatriotic. It's essential risk management. It's fiduciary duty. Think about it. In about 10 years or so, the NPS is projected to start paying out more than it takes in. They'll need to start selling assets.
I see. If all their assets were in Korean won, in the KOSPI, for example.
Selling those off in massive quantities would absolutely crash the domestic market. It would be disastrous. By investing a large portion overseas, they diversify, they reduce that future selling pressure on the Korean market, and they can liquidate assets more stably when needed. It's a necessary hedging strategy.
And this dollar demand from the NPS isn't going away. It might even increase.
It's expected to increase, actually. There are plans to raise the national pension contribution rate, maybe from 9% currently up to 13%. More money coming in means even more needing to be allocated overseas, likely meaning more dollar demand.
Okay, so massive structural demand. Now, didn't the BOK and MPS used to have a way to sort of manage this impact? Something about currency swaps?
They did. It was a crucial tool. They used currency swaps between them to, let's say, smooth out the NPS's dollar purchases, effectively masking some of the immediate downward pressure on the won.
But that stopped.
It had to stop. The U.S. Treasury explicitly called this practice out. They designated it as foreign exchange market manipulation.
Really? Manipulation.
That was the term used. Essentially, the U.S. saw it as an artificial way to prop up the won's value, a sort of hidden intervention. They issued a warning, and that mechanism had to be dismantled.
So a major defense mechanism for the won is just gone.
Gone. A huge loss for the BOK's ability to manage volatility.
Wow. Okay, that brings us to theme 3, fiscal and external vulnerabilities. With fewer tools, the underlying vulnerabilities become more exposed, right? Cause 5 seems related to the interventions we already talked about, limited foreign reserve capacity.
Exactly. All that massive intervention needed to fight the M2 growth and the rate gap, it wasn't free. It significantly depleted Korea's foreign currency reserves. So the BOK simply has less ammunition left in the tank to fight the next battle, to stabilize the market if there's another big upward surge in the $1 rate. Their buffer is smaller.
Okay, less firepower. Then Clause 6 mentions worries about the fiscal deficit.
Yes, the government's proposed budget, showing a significant deficit, caused some jitters in the market, concerns about sovereign debt levels.
And how does that affect the won?
It risks triggering capital flight, particularly from the bond market. Foreign investors holding Korean government bonds might get nervous and sell, converting their won proceeds back into dollars, adding more downward pressure. We actually saw this reflected in bond yields. The 10-year Korean Treasury yield jumped from around 2.8% up to the 3.2, 3.3% range. That's the market pricing in a bit more risk.
Got it. Now, Cause 7 sounds quite specific and maybe less well-known. Mandatory annual U.S. investment.
This is a really critical structural constraint. Korea is apparently required to invest $20 billion every year in the United States.
Required. By whom? Or is it part of an agreement?
The sources don't specify the exact mechanism, but frame it as a mandatory outflow, $20 billion a year heading to the U.S.
And what's the impact of that $20 billion outflow?
It basically cancels out any natural growth in foreign reserves. On average, Korea might accumulate around $20 billion a year in reserves through trade surpluses and other inflows. But if $20 billion has to go out the door to the U.S. each year, the net effect is zero growth in reserves. The BOK's war chest, their ultimate defense line, can't get bigger. It severely handicaps their ability to intervene effectively over the long term.
That's huge. So reserves are depleted from past interventions and structurally prevented from growing.
A really tough spot for the BOK.
Okay, finally, cause number 8, the neighbor effect, specifically linkage to the Japanese yen.
Right. This is a more recent but worrying development. The won used to track the Chinese yuan more closely, but lately it seems to be decoupling from the yuan and coupling more strongly with the Japanese yen, JPY.
And the yen has been
Weak, very weak. Japan sticking to its own ultra-easy monetary policy. The yen went from, say, 140 per dollar earlier in the year to 147 in October, and now it's pushing towards 154.
So as the yen weakens significantly, it drags the won down with it.
Exactly, because Korea and Japan are major export competitors in many global markets. A much weaker yen gives Japanese exporters a price advantage, putting pressure on Korean companies and, consequently, on the won. The won gets pulled down partly just to maintain competitiveness.
Okay, let's just pause and recap. We have 8 deep, fundamental reasons stacked against the won.
Yep. The massive 41-month interest rate gap favoring the dollar, the explosive 20% M2 money supply growth in Korea,
Right.
exporters having no incentive to bring dollars home,
Makes sense.
the National Pension Service constantly demanding dollars for overseas investment, the loss of that BOK NPS swap mechanism that used to help,
Big one.
depleted foreign reserves from past interventions,
Less ammo.
fiscal deficit worries potentially scaring off bond investors,
Okay.
and that mandatory $20 billion annual U.S. investment capping reserve growth, plus the yen dragging it down.
Wow. That's quite a list. It paints a pretty clear picture of sustained pressure.
It really does. These aren't just temporary market fluctuations. They are deep structural factors.
So, given all that these 8 powerful headwinds,
Yeah.
what's the practical takeaway? What's the strategy for the individual listener trying to navigate this?
Well, the core principle, the one that's proven effective according to the analysis, hasn't changed. It's about strategic timing based on trends, not trying to predict the absolute peak or trough. The advice is, wait for the exchange rate to dip below its 3-year moving average. That's your window to convert won into dollars if that's part of your long-term allocation strategy. Don't chase the highs. Use the relative lows within the established trend.
Okay, be patient and use the average as a guide. What is that 3-year average right now? Give us the number.
The current 3-year average exchange rate is 1,353 KRW per USD.
1,353. So the strategy is to wait for the rate to fall below that level before converting KRW to USD.
That's the disciplined approach suggested, and it's not just theoretical. These opportunities do appear.
We've seen them recently.
Absolutely. According to the data, the rate was actually below this 1,353 average. Just 5 months ago, it hit 1,346.
Okay.
And even more recently, back in September, it was around 1,371, still relatively close to that average, offering a reasonable conversion point compared to the highs near 1,450 or 1,460.
So those were the moments to act
It's
based
an
on
act.
that 3-year average rule.
Exactly. Those were the windows.
Okay, so let's synthesize this deep dive. We saw some temporary relief factors from the U.S. side recently, but they don't touch the core issues.
Not at all. The 8 fundamental problems, especially that huge interest rate gap driven by BOK policy, the legacy of excessive money printing, the structural NPS dollar demand, and that crippling mandatory U.S. investment, those are all still firmly in place, unresolved.
Right. And that leads us to the final kind of provocative thought for our listeners to mull over.
Which really centers on timing and policy inertia. The key driver of several of these issues, particularly the interest rate gap and the money supply, is the Bank of Korea's monetary policy. And the current BOK governor's term runs through April 2025. It's considered highly unlikely there will be a major policy reversal, like significantly hiking rates, to close the gap with the U.S. before then.
So this institutional timeline basically suggests the core policy drivers pushing the one down are likely locked in place for at least another, what, year and a half or so?
That's the implication. Unless some other major external factor drastically changes things, the current policy stance and therefore the upward pressure on the $1 rate seems likely to persist through that period.
So the question for you, the listener, is, knowing that timeline, knowing these structural pressures are likely to remain for the medium term, how does that influence your personal financial planning and decisions over the next year or so?
A critical question indeed.
Definitely food for thought. Thanks for breaking down all those complex factors for us.
Always a pleasure. Glad we could dive deep into it.